following information is being presented on the understanding that it is intended for information purposes only. None of the presenter, Desjardins Financial Security Independent Network, or Desjardins Insurance, has been engaged for the purpose of providing legal, taxation, or other professional advice. No one should act upon the examples or information without a thorough examination of the legal and tax situation with the appropriate professional advisors. All right, now that we got that out of the way, I want to welcome everybody and thank you so much for joining me this evening on what is my very first live webinar. My name is Mehul Gandhi and I'm a certified financial planner serving business owners, professionals, and their families in British Columbia and Alberta. Let's go through the agenda for tonight. We'll start off by talking about the idea of leaving a legacy with life insurance. Then we will get into some background and an overview of a particular strategy. I'll then try my hardest to keep you awake while I go over some necessary technical information, and then I'll conclude with a case study that'll help to demonstrate the effectiveness of this particular strategy in helping you create a legacy. At the end, don't worry, we're going to have lots of times for questions. All right, let's get into it. We all know that life insurance can be used to protect our families and loved ones in the event that we pass away. Life insurance, of course, provides a financial safety net for those who are dependent on us. Furthermore, life insurance is often used to fund final expenses and taxes that may arise upon our death. But have you ever considered using life insurance as a vehicle to transfer wealth to the next generation, thereby creating a legacy? When we die, we leave behind an estate that is made up of all of our assets. Unfortunately, those assets are subject to tax. Many people like the idea of leaving their estate to future generations, but instead, because of the tax, your estate is significantly eroded. This is one way life insurance can help. In most cases, life insurance provides a tax-free benefit. A life insurance death benefit can make up for the taxes your estate may be responsible for, or even enhance your estate by adding to the assets you leave to your heirs, thereby helping you create a legacy for your children or grandchildren. The best kind of life insurance to use in this case is permanent life insurance, the kind that never expires or increases in price. Unfortunately, permanent insurance can be costly as we get older, making it an unattractive or unfeasible option. Let's check out an alternative strategy. In this strategy, we're going to use a special type of permanent life insurance called participating whole life insurance, which generates cash value growth over time. Part of this cash value can be used in various ways, but in this example, we're going to show what happens when you use it to buy more of the same kind of insurance every year. Now, on to the strategy. A parent insures their child and is the owner and beneficiary of a participating whole life insurance policy. Anytime after the child reaches the age of majority, the parent can decide to transfer ownership of the policy to the child. Once the child owns the policy, they have the right to make policy changes, including accessing the cash value, changing beneficiaries, or surrendering the policy. In our example, the new owner eventually makes her child the beneficiary of the policy. Before we carry on, let's take a more detailed look at what participating whole life insurance looks like under the hood. This is a great time to jot down any questions you might have and ask them at the end of the presentation. I'll be more than happy to answer them. Participating life insurance provides a combination of permanent life insurance or whole life insurance protection and an opportunity for tax-deferred cash growth. The base insurance protection is guaranteed for life as long as you pay your premiums on time. The policy is also eligible to receive dividend payments, which you can use to buy additional coverage or reduce your annual premium. You can also leave them on deposit to earn interest or take them in cash. It's important to understand that dividends are not guaranteed. However, once they are issued in a given year, they cannot be taken back. That is to say that once you get a dividend in your participating whole life policy, you can't lose it. So, what have we learned so far about participating whole life insurance? It has three components: a guaranteed death benefit, a basic guaranteed cash value, a non-guaranteed dividend cash value, which among other things can be used to purchase more participating whole life insurance every year. I think this diagram illustrates this simply. The guaranteed death benefit at the base, the guaranteed cash value as the second layer, and finally the non-guaranteed dividends at the top, which can be used to build the guaranteed insurance benefit. Two questions you might be asking yourself right now are, where is this cash value coming from and what on earth are these dividends? As this illustration shows, your premium payments go into the insurance company's participating account where it's managed to meet the guarantees and commitments of all of the participating life insurance policies now and in the future. Your policy's guaranteed coverage and cash value are backed by the assets in this account. The account's earnings reflect investment income, insurance payouts, policy loans, and withdrawals, and other factors. When earnings exceed the amount needed to meet the guarantees and commitments, policy owners may be able to share or participate in these earnings. This means that the insurance company may distribute some of these earnings as dividends, although this is not guaranteed. Now, you can use these dividends in one of several ways. You can use them to increase your coverage or your policy's cash value. You can use them to reduce your payments or stop them early if the cash value is substantial enough, or you can simply take your dividends out as cash. You can also access your policy's cash value in several ways by borrowing from your policy, use it as collateral for third-party loan, or you can withdraw the cash value. Now, these events can affect your coverage and have tax implications and are best done with the assistance of a licensed life insurance professional. Let's move on to the case study. The following case study should help explain how the strategy works. Let me introduce you to John. John is a physician and has a young daughter, Lisa, who's 2 years old. John is already saving for Lisa's post-secondary education, like most Canadians, using the Registered Education Savings Plan, or RESP, but he wants to do more. He's comfortable saving an additional $2,500 to $3,000 a year for Lisa, but he is worried about attracting more tax through any new investments. The idea of creating a legacy has never occurred to him, but it does intrigue him now that he thinks about it. After careful consideration and discussion with his advisors, John decides to start a participating whole life insurance policy on Lisa's life. John owns the policy and he is also the beneficiary for now. His daughter Lisa is simply the insured person. The premium in this particular example is approximately $2,600 a year for the next 20 years, and the initial death benefit amount of the policy is $250,000. Now, this is an important note. After 20 years, the policy is paid up. John will never have to put money into this policy again. He will have spent approximately $52,000 for a guaranteed $250,000 policy. Now, as we know, dividends are not guaranteed and can change from year to year. However, for the purpose of this example only, let's assume that all assumptions made to generate the values, including but not limited to the dividends, hold. In 20 years, Lisa is now 22 years old, and again, the policy is paid up. John is not putting another dime into this policy. This cash value of Lisa's policy would now be approximately $50,000, and the death benefit would have increased from $250,000 to $420,000 and would continue to grow. When Lisa is 28, John decides to transfer ownership of the policy to her. This can be done without triggering any tax since Lisa is John's daughter. Okay, nerd alert. This one's for the tax nerds out there. Subsection 148(8) of the Income Tax Act allows for a tax-free rollover of a life insurance policy to your child, in this case, John to Lisa, if the policy is transferred at no consideration to the child, meaning at no cost, and the life insured is a child of the policyholder or transferee. Okay, back to the example. Again, Lisa is 28 years old, and at this point in time, the cash value of the policy is approximately $86,000, and the death benefit amount has grown to approximately $526,000. Since she is the new policy owner, Lisa can decide to exercise one of the aforementioned options, but she decides instead to leave the policy in force so that it can continue to grow. Fast forward in time, Lisa has a child of her own, Jake. She decides to change the beneficiary of the policy from her father to Jake, which is John's grandson. Eventually, John passes away, but this does not affect the policy as he is no longer the owner, Lisa is, and Lisa's the insured. Let's fast forward some more, and eventually Lisa passes away as well at the age of 89, leaving her son, Jake, with the death benefit of the insurance policy that her father started. Jake receives approximately $2.2 million tax-free. Now, what's happened here? John took out a policy on his 2-year-old daughter, Lisa, that eventually grew to a sizable inheritance for his future grandson, Jake. John has left a legacy across 3 generations in a tax-efficient and cost-efficient manner. It only cost him $52,000. Both John and Lisa could have used the policy in many different ways in their lifetimes, but this is just one example. So, to summarize, we all know life insurance can be a financial safety net to protect our family in the event of untimely death. It's very common for individuals with young children to take out a life insurance policy on themselves because they see the importance of doing so. However, insurance can be used in so many other ways, including creating a legacy for your future generations to remember you by. This concludes the presentation, and at this time, I'm more than happy to answer any questions you might have. You can type your questions into the chat box or raise your hand by clicking on the raise hand option under the More tab, and I'll take you off mute to ask your question. Okay, so the first question is from Bob, and Bob asks, what is the ideal age to start this strategy at? We do like the numbers when we do this with children that are under the age of 5. That being said, it does work at older ages. It also depends on sort of what your long-term goals and expectations are of this policy. Ashdown, who I think is Ryan Turner, is asking if you can increase the payment and have this paid up in shorter than 20 years, and you actually can. We can design illustrations that can have this paid up in any period of time, 8 years, 10 years, and show what the amount of premium you would have to pay. The guarantees do get a little bit altered here. Another option is if you have a lump sum amount, for example, in this case, $52,000 up front, we can use that to purchase a term certain annuity and use the income from that annuity to pay the premiums every year so that you don't have to worry about it. And we have another question here from Josh. He's asking if we can use this policy as collateral for a bank loan. And that's a really good question. Yes, it's a common use for these types of policies, especially once the cash value grows to a significant amount. We can use both the guaranteed cash value and the dividend cash value as collateral with a bank or financial institution, and it would be the loan would be considered a secured loan and hopefully get you some better rates. However, we do see that the Bank of Canada has been raising rates recently. Okay. All right, it doesn't seem like there's any more questions. So at this point, I'd like to thank you all for attending this webinar, the first of many, I assure you. If you did find any of the information valuable, or you just want to know more about what we do, please sign up for our mailing list and follow us on social media. And a recording of this webinar will be emailed to all of you, so please feel free to share it. Thanks again, and have a wonderful evening.